Thank you very much, Ed. Ed and I have been friends for a number of years, and he is just so thrilled that I've gotten in touch with my inner Republican. He has persuaded me about charter schools, and he has talked to me about the issue of property taxes around the state, and I can't thank him enough for his assistance. Also, I would like all of you to know that thank you, with the great help of Noah Latif and others at the Foreign Policy Association, I was able to be tutored on a number of international subjects, and particularly international commerce, and one session about the relationship between New York and Quebec from the Policy Association. And so when I walk around here and act like I know what I'm talking about, so many of you should know that it's been the input of this association that has helped me, and I can't thank you enough. And it was great to be elected at 31, but then to hear that the Premier of Quebec started in government at 26, I feel properly upstaged, and we'd like to welcome the Premier Jean Charest. And I would like to also to greet the Director Delegate of the mission here in New York, Robert Keating, and for all of his work and assistance to us here in New York. A post formerly held by a friend of mine, Michel Robitaille. So we are trying to enhance the cooperation between New York and Quebec. There was a summit in Quebec City on May 20th, a day I remember for two reasons. One, it was my birthday, and it was the first time I spent my birthday in the hospital. And so I missed that conference, but I have promised the Premier that I will be there on November the 17th. I know that that's a Monday. I will be there, Premier, and this time there'll be no excuses. If I'm ill, I'll have myself medevaced to Quebec on November the 17th. So thank you for that conference. The Premier is going to speak after me, so just briefly, I wanted to talk for a moment about the awareness of interconnected cooperation as it impinges upon the concept of international commerce. We are recognizing, particularly with our, in the United States, our national economy reeling to its core, as Mr. Cox said, maybe in such a fashion that has not been seen since the Great Depression. By the way, Ed, I said that 3 months ago and was ridiculed by all of the tabloids and media operations of note, and now all the business news stations and magazines, now they say it, and we're supposed to believe it. But the point is that we are encompassing great difficulty in terms of our economy, and what happens in our economy because of the precious nature of global finance affects people all over the world. And the question is not how we are going to resolve it, but rather how we resolve it together. And so as we look to the next few years, we recognize the increase in trade between New York and Quebec. We've increased our trade with Quebec by 19.2% just in the last year to $2.2 billion of trade. Quebec has been exported to the United States, and particularly to New York, at a level of $6.1 billion just over the past few years, and we're looking to further that cooperation, and this is why we hold these summits and meetings as a prelude to an endeavor that will help us all. We recognize that we are competitors. The Premier told me that just a few years ago, the Canadian dollar was 59 cents on the United States dollar, and that he raised it to $1.09. That hurt my feelings. But I was thrilled to hear that it's back down to 94 cents on the dollar. And so that type of competition is important, and we won't always agree, and we'll always be competitive, and yet, at the same time, the success of each of us is interrelated to the success of all of us. So it's a balance between our natural competitiveness but our understanding of our place in the global market that is so important. So who would have ever dreamed when 24 securities investors sat under a buttonwood tree, which would eventually become Wall Street 200 years ago, that this would affect every household in the world in this time? Who would have ever thought as much as 100 years ago that a New York investment bank could affect the the welfare of a family in Japan 100 years later? And who would have forecast that only 10 years ago the inability of a family in Buffalo, New York to pay its mortgage could bring down a bank in Berlin? So we really have to understand the interconnected nature of the relationships between our countries, between our foreign direct investment, between our commercial interactions, and between the diplomacy of our governments. When you think about the last difficult economic period in this country, 20 years ago, when $500 billion was lost by savings and mortgage loans associations whose leadership frittered away hundreds of millions of dollars in reckless schemes, that the United States government was inevitably, as difficult as it was, able to truncate this difficulty. This could not happen in this type of a market right now. And this is where we have to understand the effects that are relieved from the actions of private and public industry as it relates to the inevitable inertia of business. And so when you look at just the past few months and you realize that Bear Stearns and Merrill Lynch combined with Lehman Brothers have commanded 27,000 jobs in New York, when you realize what that has done to our economy, you can understand why we took the position that we took in terms of how we handled AIG. It wasn't just that it was 8,500 jobs in New York. It wasn't just that its payroll was $900 million and its leverage on our economy was $2 billion. It was that AIG is active in 130 companies, that it has 116,000 employees, that it had 85 million customers around the world, and that its tentacles reached into other areas of government, whether they be mutual funds, whether they be pension funds, other related banks. There is an insurance company that is the largest bondholder in Wisconsin, and the governor of Wisconsin called me to help save the Capital Guard Insurance Company because it's a subsidiary of AIG and has such a great effect on the Wisconsin economy. This would have been heard round the world had there not been the willingness of the Secretary of the Treasury, Henry Paulson, and the head of the Federal Reserve, Ben Bernanke, to come in and help to mitigate the damage. And whether they liquidate the insurance company or they find capital to preserve it, it will not have the deleterious effects of what would have happened if that company was allowed to go down. And so as we look to the next few months, it is staggering to hear that $700 billion of taxpayer money will have to go to a bailout of many of these companies whose risk was not managed, and at times it wasn't that they didn't manage their deficit, it's that they didn't even know what it was. And just hearing and reading in the last 24 hours that it won't take $200 billion but $300 billion to save Freddie Mac and Fannie Mae, then you know that that $700 billion will be $1 trillion of American taxpayer money that will go to bail out these firms. And yet, we have to do it. We're not doing this to give a pat on the back to those who might have managed more effectively. We're doing it because they really create the moral hazard, because not just the American economy, but the world economy will suffer for it. Because of the problems earlier in the year, we cut our interest rates 7 times. Because of that, we've stimulated inflation around the world. China, India, Indonesia, and Saudi Arabia have 8 to 10% inflation rates. Malaysia's is 14%, 23% in Argentina, and 29% in Venezuela, 50% in many of the African countries. So what happens to some of us inevitably encompasses the economic plight of all of us, and we have to recognize that. But there are ways, I'm confident, that we can relieve this problem if we start to examine our historical connection to finance and how we can make the system work better. We've been through some of these problems before. We've ameliorated the difficulty, but let us learn from the history that has put us in the lucrative position that we are in now, that we can depend on our government to be part of the solution. And this was the case after the 1906 economic disaster that hit the United States and hit New York, that in 1913 the desire was to have a strong centralized federal bank. But President Woodrow Wilson fought that off, and that was the creation of the Federal Reserve. And that really set the tone for what would be the 20th century's view of how to separate the public and private banking industries and to create a system that works for all of us. He eschewed the opportunity to have one central private federal bank managing, and he recognized the ability that we would have to balance that with a public finance that would accompany private investment. In 1933, on July 4th, the anniversary of the independence of this country, Franklin Delano Roosevelt shook the world up when he contacted the London Economic Conference and announced that he was taking the United States off of the gold standard. As a matter of fact, he described the gold standard as a fetish of thought to be international bankers. Well, maybe his words were an overreaction, but he still took the United States off the gold standard and created a situation where they forced the international markets into the ability to buy and sell and to transfer currency. He went on in 1933, in a sense, to sign the Glass-Steagall Act, which was to mandate that here in the United States that banks either be deposit banks or investment banks. Now, it's interesting that in just the past 48 hours, the federal government has granted permission for Goldman Sachs and Morgan Stanley now to become commercial banks as well as retain their investment status. The Glass-Steagall Act was repealed in 1999, so the world has come full circle, and we're moving back toward this centralized bank model, which is really a 20th century modality trying to handle 21st century problems. And it's my suggestion that whoever becomes president, since they say they both want to reform Washington, they can start by looking at history and seeing further evidence of how that standard can be changed. In 1935, what President Roosevelt did was he moved the Federal Reserve back to a centralized location in Washington, moving it from Wall Street to Pennsylvania Avenue, demonstrating that government has to play a part in this structure. In 1936, at the tripartite conference, where Britain and France and the United States finally settled on what would be a uniform standard for the transfer of currency, again, we see this emergence of the concept and the recognition of the international market as part of the solution to economic problems, culminating in 1944 in what was the signing of the Bretton Woods Agreement, which really established a World Bank, an International Monetary Fund, helped emerging countries, and was probably the most significant economic achievement of the 20th century, when all the countries of the world started to understand their interrelated connection to each other. And so it is sometimes disappointing to hear the signal from the federal government that after we put out the fire and make sure that the barn is safe, that we're going to go back to standards that have not worked before is troubling to me. Reading the article written in the Financial Times by Sam Nanapoff in August about the July 7th decision of the Secretary of the Treasury to have the Federal Reserve further monitor and scrutinize the conversion of Freddie Mac and Fannie Mae to this a standard where a strong centralized bank would operate, makes me feel that we're not going in the direction that we should. And I only hope that the proposed independence of both of the presidential candidates in this particular race is a prelude to an understanding that it is the international standard, not a centralized American model, that should foster and create further cooperation between our different governments and between our different peoples. So I think that as we look to the next decade and we recognize the inertia inherent in finance and in investment, we realize that if we start to look more away from the problems inherent that are existing today to what would be our idealistic way in which we can create international commerce and have our flourishing economies act in a synergistic way, I think we first have to look at who we are, and what we can be. We are now an international government. We are now interacting with each other very much the way that we used to interact with ourselves. We are recognizing that distance and time have changed forever, and that our marketplace now must be open and transparent, that there must be the management of risk, and there must at all times be an understanding of regulation. We do not feel that an overregulation, an overreaction to this problem will help the marketplace, but we certainly suggest that there must be an understanding of the events that have overtaken us, not just in this recent downturn in the economy, but what has been an historic nature of ebbs and flows in our economy, and we recognize what would be the solutions that involve the interaction and interconnected cooperation that we have in our countries. So thank you very much for having me today. It's been a pleasure speaking with you, and thank you for inviting me.